CA Sunil Kumar Mandava, past chairman of Hyderabad branch, immediate past chairman of Hyderabad branch, CA Pankaj Kumar Trivedi, our treasurer and good friend CA Rajambal MS, and welcoming all the members once again. I request chairman to give overview of the today's program, please.
Yeah, thank you, Satish. Respected senior members and dear delegates, and land speaker of the day, the senior member of Hyderabad branch, CA Sri PVSS Prasad sir, and regional council member Sunil Kumar Mandava, and my immediate past chairman Pankaj Kumar Trivedi, and secretary Hyderabad branch Satish Kumar Mailvarpu, and Rajambal ma'am, and all the friends, very good morning and warm welcome for today's webinar on class by class analysis and budget, direct tax proposals and budget, Union Budget 2022. Prasad sir, it's really great honor to have you with us today to discuss on direct tax proposal and class by class analysis. Friends, we all know about Prasad sir. He's a senior chartered accountant from Hyderabad, and he started his practice, I think, in 1986. And he's an eminent speaker and presented papers across a lot of international dias. Sir is also author, we know. He's an expert in international taxation. And generally, sir, we won't find time of this, sir. For taking a 10 minutes of sir time is also a little bit difficult. But with a great passion, for the last 20 years, I think Pankaj sir is more than 20 years. Every year, Prasad sir will speak on a budget, 2 to 3 hours. Every year, he present a paper on a budget session. And this year also, I am extremely sorry, Prasad sir. Prasad sir only told me, Master, class by class analysis budget is there. On budget, class by class analysis is there. Let us do the program. Like that, Pankaj sir and Prasad sir only initiated this. Thank you so much for your commitment and support for Hyderabad branch, Prasad sir. And really proud to have members like you for Hyderabad branch. Thank you, sir. Once again, welcome to PVS Prasad sir. And senior member, Pankaj Kumar Trivedi sir. Satish, I request you to please request Pankaj Kumar Trivedi sir to say a few words about Prasad sir, particularly who worked along with Prasad sir in the managing committee. What is it?
Thank you, chairman. Now I am requesting our immediate past chairman, CA Pankaj Kumar Trivedi, to say a few words about today's topic, and your good friend, our senior member, CA PVS Prasad sir.
Unmute, sir. Pankaj sir.
Thank you, Satish. Chairman Machara sir, newly elected regional council member Sunil Mandava, Speaker of the day Prasad, my colleagues in the committee, Rajam and Satish, and we are all delegates. February has become now synonymous with two things. One, finance minister presenting the budget, and then we come out with a trailer. Of course, we are missing M.R. Vikram.
Sir, yes.
So who is not well and he wanted to be excused this time. So Vikram starts with the economy, and few good speakers earlier used to talk on very triply about the direct taxes and indirect taxes. And then the real movie used to come from CA PVSS Prasad. His analysis, clause by clause analysis, is one of the most sought after things. And by the time all of us would have discussed the budget, search what is there, what is not. And I know Hyderabad branch has always provided the final and the specific answer about what is the direct taxes changes which happened in budget through PVSS Prasad. Of course, I've been asked to talk about PVSS Prasad only, but I always call him as my chairman. And if we get at least 10% of the meticulous preparations he has, and at least about 10 to 15% of the discipline, if we are able to inculcate in ourselves, I think all of us would be successful. Very proud to have you, Prasad, and I'll not take much time. So over to you. Thank you, Machara sir, for giving me this opportunity.
Thank you, sir. Thank you.
Thank you, Pankaj Kumar Trivedi sir. And now I am requesting our past chairman and regional council member, CA Sunil Mandava, to say a few words about today's topic.
Thank you, Secretary Satish Kumar. And I thank Machara, Chairman of Hyderabad branch, and Pankaj Trivedi, ex-chairman of Hyderabad branch, and CA Rajambala ma'am, committee member, and other committee members. And also I thank CA PVS Prasad Garu, who is also our speaker in my chairmanship as a budget person. I know him very well. He is a good speaker on the union budgets, and he explains class by class in a very well and in a depth way, so that we can learn from him a lot of things in the on every subject, in every topic, in whether in indirect taxes or direct taxes or in a FEMA related issues. He is an expert where we can learn everything from him. So I thank him once again for his presence today, and over to previous S. Prasad Garu.
Yeah, thank you, Sunil sir.
Thank you.
Now I am requesting CA Rajambal MS, Treasurer of Hyderabad branch, to introduce today's speaker, please.
Thank you, Satish. A very warm welcome to Chairman Hyderabad branch and Secretary Hyderabad branch, SIRC member Sunil Kumar Mandra Garu, past Chairman Pankaj sir, and all the other committee colleagues. A very warm welcome to all the delegates. I'm very glad to see the number above 200. We've always been very, very attached to this seminar, and a very, very warm welcome to Prasad sir. He's been like a mentor for me from the moment I have known him, and it's a great honor to introduce him. Prasad is a practicing chartered accountant and an information system auditor, partner in Prasad and Prasad and Co. Chartered Accountants since 1986. He's the past chairman Hyderabad branch of ICAI. He's the past president of AP Tax Bar Association, past chairman of International Fiscal Association Hyderabad subchapter. He is a past member of Executive Committee of International Fiscal Association India branch. He co-authored a book titled International Taxation, a Basic Study, published by Book Corporation, Kolkata. He was appointed as one of the branch reporters for IFA Congress 2010 that was held in Rome, Italy, on the subject Treaties and Treaty Avoidance, Application of Anti-Avoidance Provisions. He was the chairman of All India Federation of Tax Practitioners, South Zone for the term 2010-11. He was co-opted member of the Committee of International Tax of Institute of Chartered Accountants of India for the year 2016-17. He was invited to speak at IFA Asia Africa Conference held in Mauritius in the year 2012, 14, and 16. He is co-opted member of Committee of International Taxation of ICAI for the year 2018-19. Elected Vice Chairman of IFA India Branch 2018-20. He was invited as a panelist at Asia Pacific Regional Tax Conference 2016 held in Seoul, South Korea in the year May 2016. This is all about the profile, but other than that, we know Prasad sir and international taxation in Hyderabad are two words which go together, you just can't separate. And also the clause by clause analysis of budget. We've always been waiting to hear from you, sir. I will not consume any extra second also from here. Back to you, Satish.
Thank you, Raja. Now I'm requesting Prasad sir to take forward the session, please.
Thank you very much, Chairman Ms. Macharao, my good friend Pankaj, Mr. Sunil, Mr. Satish, and Rajam. And in fact, Rajam has been part of the International Tax Force also when we had one of the sessions here in the Center of Excellence. And so nice to be back this day for learning what is put in Finance Bill 2022 with respect to the direct tax proposals. In fact, I would like to share screen my presentation. Just give me a minute. And
yeah, request delegates, please don't post membership number and name in the chat, please. It detracts the speaker. And any questions, request you to please post in a Q&A only. And attendance will be taken based on your Zoom details.
so, friends, we are at the threshold of a new era of digital economy, especially in India. The way in which digitalization happened from last 2 years after the pandemic has set in is really mind-boggling. And all of you would have observed the economy is progressing very steadily in spite of the pandemic. And in fact, we were all scared that this third wave would really disturb us. God's grace, it has not done so, and the third wave is slowly receding also. And the economy is really strong, resilient, and moving ahead. And very heartening to note the highest GST collections in the recent month. That is what is observed by the Honorable Finance Minister in her speech. And we expect a growth rate of 9.2% in the coming year. And in fact, the double-digit growth is not very far off. And it is also very heartening to note one of the biggest PSU disinvestment success, that is the Air India. And in fact, all of us who have been seeing Air India disinvestment in news from last 4 or 5 years and back and forth happening. And ultimately, the disinvestment happened in this month, that is in the month of January, just before the budget. And that is one of the biggest successes of this government, there's no doubt about it. And all the more interesting is we are going to have digital currency in the year to come. And central bank's digital currency is in the offing, that is officially announced by the Honorable Finance Minister. Be that as it may, and even on the international front, as you all know, India being part of the G20 is a very, very strong and vocal observer in the OECD. And in fact, we have been canvassing the source rule from last, more than 2 decades or 3 decades, stating that a country from where a source of income generates for a non-resident, such income must get taxed in the source country. That was originally not palatable to the resident countries, the advanced countries from the West. But all of us should really notice with great satisfaction that this rule has been endorsed in the advent of digital taxation. Now, the biggest burning issue is how to tax digital transactions. So, on that, OECD G20 inclusive framework of around 130-140 countries is working towards achieving a consensus which is almost done on 8th of October 2021 by entering into a global tax deal. Why I am saying so, now the digital tax, international tax, and domestic tax would get intertwined so much, and you cannot anymore conveniently think that international tax is an alien subject and we can think about later. It's not so. Your own regular transactions will have a flavor of international tax in the days, months, and years to come. More so of the digitalization of the economy. Today, service providers sit across the world and render services even to the smallest business person in India, to the biggest corporate houses. So that is the era in which we are in. And we are now talking about artificial intelligence, data analytics, and more so, now the new buzzword is the cryptocurrency, against which the direct tax proposals have been unfolded by the Honorable Finance Minister, which we will discuss. Crypto has taken so strongly, especially from last 1.5 years. And in fact, there are about 10 crore investors from India into crypto. Everyone was keeping their fingers crossed whether this crypto investment, cryptocurrency investment would be banned, and what if it is done so. So thank God, no ban as such happened now, and the tax proposals have been unveiled. We will just come across, I will go through those proposals as we progress in the presentation. So friends, in this backdrop, the budget, I would definitely say, is one of the best budgets that has been presented by the Honorable Finance Minister, and trying to really balance the situation on the economic front, and at the same time meeting the international obligations, and really looking at the digital transformation in a big way. So in this backdrop, let us just run through the most important clauses in the Finance Bill 2022 with respect to the direct tax proposals. I would not say that I'm going to cover all the 84 clauses. There's no point spending time on, minor amendments, small amendments, which we need not, which there for want of time, we can't do that. But at the same time, we should not miss discussing important amendments and far-reaching proposals. So let us start getting into the proposals, how they have been placed before the Parliament for a discussion now. And all the stakeholders are in the process of preparing their post-budget memorandum from various platforms. So let us just quickly get into how the proposals have been unfolded. So thank God there is no tinkering with the personal tax rates, and there was a fear among many, especially among the high net worth individuals, that the wealth tax may come back in the advent of pandemic. Even last year we had that doubt, and especially wealth tax is one thing, and estate duty, that is the succession, that is the inheritance tax. Luckily, both have not been brought either last year or this year. That's a very good move from the government. And there was also an apprehension that the new taxes other than this wealth tax and the inheritance tax, there could be some more new tax levies to meet the additional expenditure in the advent of pandemic, but that also not happened. And in fact, even OECD in its documents released last year in the advent of pandemic suggested governments to go in a particular fashion with respect to the new taxes to mop up revenues for meeting the COVID expenditure. But thank God, Indian government has not done anything of that sort. That's a great feature in both the years we need to notice. So in this backdrop, there is no change of the personal tax rates. And of course, there is no further reliefs or increase of threshold or anything happened like that. One good thing that has come out is surcharge for association of persons has been capped at 15%. This association of persons is a status where we come across in large infrastructure projects. Corporate receiving a particular large infra contract would tie up with the other corporates and enter into a consortium. And such consortium would carry out the work in the status of association of persons. There they have been suffering with a high surcharge rate. Now that surcharge has been capped at 15%, which is a great relief. In the same way, the surcharge also got capped for cooperative societies, especially the banks, cooperative banks and all are going to have that benefit. The 12% surcharge has been brought down to 7%, especially in the MSME sector of the cooperatives, where they have an income between 1 crore to 10 crores. And even the alternate minimum tax, which is a replica of minimum alternate tax, like your 115 JP for the corporates, AMT has been there in the statute book. There is a mismatch that has happened or an inconsistency that has been there, which is now removed. The MAT rate has been brought down, but alternatively, this AMT rate has not been brought down. And that 18.5% has now come down to 15%, which is a heartening feature. And coming to this charitable institution and trust, somehow the government felt that there is an urgent need to align both exemption regimes, that one is under the 12A regime and the other one is 1023C regime. They would like to make both the provisions consistent and uniform and bring in more regulatory measures to check any sort of abuse by the trustees or by the founders of the societies. and thereby also bring in a sort of deterrent if at all any of the objects of the trust or society are not complied with in a proper manner, or the application of funds doesn't happen in the manner it is prescribed, then some deterrent provisions have been brought in. So now ensuring their effective monitoring and implementation is one of the objectives, bringing consistency in the two exemption regimes and providing clarity on taxation in certain circumstances when some of the provisions have been violated. So let us quickly look at broadly, in fact, let us see what are the in case trust or institution passes any unreasonable benefit to any trustee or any person specified in Section 13 of the IT Act, it is proposed to levy a penalty. Penalty, a new penalty in the form of 271 AAE has been proposed, and such penalty is going to administer some 100% penalty if at all the income applied directly or indirectly by such person for the benefit of any trustee or any person referred to in Section 13, subarticle 3. That means there is always a complaint from the revenue authorities that undue benefits are being passed on to the trustee in the form of salary, other perquisites and all that. Anyhow, there are a number of judgments courts have always endorsed. Just because he is a trustee, there is no embargo that he should not take any salary for the services he is rendering. In spite of all the jurisprudence what we have. And now they have taken a view that if at all there is any benefit that has been passed on, unreasonable benefit, that you must bear it in mind. If at all it is reasonable, there is no question of any disallowance. That is where again you are going to have litigation. Now, what is a reasonable benefit and what is unreasonable benefit? So penalty in case of violation in the first year would be equivalent amount what is quantified as wrong application or wrong usage for the benefit of the trustee or as the specified person. So if at all revenue takes a view that 10 lakh rupees has been wrongly applied for the benefit of one of the trustees or one of the specified persons, then the same amount can be levied as a penalty. If at all this is for the first time, if this happens in the subsequent year and then onwards, it would be 200%. This is really a very, very subjective penalty which is going to come into play, with which we have to be extremely careful. And then 112AB4 is proposed to be substituted to give the principal commissioner or CIT to call for documents, information, and make inquiries and pass orders cancelling or refusing the registration in case where the principal commissioner or CIT notices one or more specified violations or on references from the assessing officer. So as you know, the registration of a trust, when once it has been approved under Section 12, originally there was no power for the commissioner to undo it. That was the case, if I remember right, up to 7-8 years back. Then they have brought in a provision in the regime giving powers for the commissioner to call for information and all that. The same power is being further expanded and amplified to ensure that the regulatory, the authority who has power to grant registration has also the power to cancel and reject such a registration. So such authority is now going to exercise this power. We expect him to exercise this power in a very judicious manner and not in an aggressive manner or not in a coercive manner. And if at all such commissioner or the principal commissioner comes to a conclusion there is a violation, of specific provisions of the law in this regime, then there is a threat of cancellation of the registration. The order regarding cancelling and refusing the cancellation shall be refusing or ordering cancellation of the registration shall be passed before the expiry of the period of 6 months from the end of the quarter in which the first notice is issued by the principal commissioner. And definitely the principles of natural justice must be complied with, and hearings must be provided to the concerned persons who matter in those trusts and societies, for them to represent how there is no violation as per the law. Of course, presently trust or institution is denied exemption in case, especially under 1023C, if their commercial receipts are in excess of 20%, violating the provisions, and not getting books of account audited, and non-filing of return of income. So all these, year after year, the restrictions start increasing or being added year after year. Thereby, there is an issue now that one must be extremely careful in running a society or a association under 1023C. And when once they find that there is a violation, the income of trust or institution is going to be recast. Even the exempt income will come into the category of non-exempt income for the purpose of taxation, which is really very undesirable and which needs to be taken care. And once it comes to the taxable portion on account of violations, then you have a new charging section in the form of 115 BBI. 115 BBI is a new provision inserted, which will levy tax at the rate of 30%, that is the highest maximum marginal rate, and no deduction of any expenditure or allowance or set off of any loss would be also slapped against this income, which is the biggest deterrent. And then it has been clarified by inserting explanation to section 11 and 1023C that the word application means actually paid. This is another thing. See, application of income, you have some sort of flexibility and some leverage in the existing provisions. Now, application of income means you have to really spend, and that should have been really paid. Unlike what was happening in the past, when we used to consider if at all it is incurred, it is good enough whether it is paid or not in that year. Now we go by the concept of payment, irrespective of the method of accounting being followed by the trust or the institution. This also needs to be taken care. And in fact, just one minute. These slides are jumping. So, especially these trust and institutions, the other day we had a panel discussion on IFA forum at the India level, where Kamlesh Varshni, the present sitting joint secretary, and he is rank of the chief commissioner and a very well-informed revenue officer, and he is the trendsetter, or he is the first officer to canvass and make the advanced pricing arrangement under the transfer pricing regulations very successful in India. He is now in the policy, policy portfolio, tax policy portfolio of the CBDT, and he was one of the panelists in the IFA panel discussion, which has happened day before. And in fact, he mentioned that one of his colleagues who is in the budget exercise took up this thorough revamp of these trust provisions to make both the taxation, both the exemption regimes consistent. And this is a big exercise which is carried out. And this is time for every organization or the association to come up with their grievances and representation well on time, so that it should catch up with the post-budget exercise, so that if there are any anomalies, if there are any harsh provisions that have been brought in this particular amendment of trusts and institutions, it must, the post-budget representation of various associations should really help set it right in the right format. We do welcome the revamp of the provisions, but at the same time, if there are impractical provisions or aggressive provisions and asking too much from the trustees to carry out all these, features, if they are figuring in the proposals, we must readily represent and ensure that the right format or the properly modified provisions or proposals should enter the statute book. And then let us quickly go to section 14A, which is a very, very vexed provision in the statute book. You all know that any expenditure which is incurred against an exempt income, such expenditure should be disallowed because the income is not being brought to tax. The corresponding expenditure should not be allowed as should not be allowed as a charge against the profit in the profit and loss account. And in fact, this has come into the statute way back in 2001 or 2003. Since then, this has seen a lot of litigation before various courts of the country, right up to the Honorable Supreme Court. And in fact, we had judgments coming in Godrej Soaps case and several other judgments which have said, if at all there is no exempt income that is earned at all during the year, there is no justification of disallowance of corresponding expenditure. You have a complaint only when there is an income which is forming part, which is earned by the SSC, but is not forming part for the taxability. Then corresponding expenditure against that must be disallowed. If at all there is no income at all which is earned during the year by the SSC, then how is it justified to disallow the expenditure? This is as simple as that. And in fact, against this, we have Rule 8D, which has been there from several years after these provisions have come into the statute book. The Rule 8D has been brought mainly to facilitate an assessing officer quantify the expenditure for disallowance. So what it says if at all the quantification of the expenditure by the SSC is not to the satisfaction of the assessing officer can follow Rule 8D and try to disallow the expenditure as per Rule 8D. So Rule 8D has been brought into the statute book almost 15, 12 years back. So there again, you have a lot of litigation that has come up because the rule applies with a fictional approach. So whether you have incurred or not, they will quantify so much of amount for disallowance. This has created a lot of, opposition from the corporates, and a lot of litigation has been there from several years. Now the latest movie is proposed to insert an explanation. What is the explanation going to do? Explanation is going to read as under. Explanation is going to say, for removal of doubts, of course, this explanation is going to be effective only from 2022. And the very wording is inconsistent with that, for removal of doubts. For removal of doubts, always we take it as a retrospective amendment. And removal of doubts would always mean that the provisions have to be understood this way at any point of time, whether it is in the past or present. But anyhow, there is a dichotomy in the usage of words in the explanation as against the proposal from which date they are going to bring it into effect. For removal of doubts, it is hereby clarified that notwithstanding anything to the contrary contained in the Act, the provisions of this section shall apply and shall be deemed to have always applied in a case where the income not forming part part of the total income under this act has not accrued or arisen, whether it has accrued or arisen in the or has not been received during the previous year, relevant to an assessment year, and the expenditure has been incurred during the said previous year in relation to such income not forming part of the total income. The whole target of this explanation is whether you have earned, accrued, or received the exempt income during the year or not, the corresponding expenditure which you have incurred during the year must be disallowed. So this is to neutralize some of the judgments rendered by the courts like Chettinad Logistics. The Honorable Supreme Court said if at all there is no exempt income during the year, there is no way you can apply Section 14A. You have plethora of other cases, or there is one more Supreme Court judgment in Oil Industry Development Board. And of course, this 14A applies across the board to the business income or the other income, and non-corporates also when they have, like institutions, any institution having exempt income also, more so they have exempt income there. It can also apply if there is a mix of exempt and taxable income. And all these judgments have been overruled now. Now, how it's going to unfold in the years to come, we have to wait and watch. The undesirable, approach of the revenue is that whether you have earned or not, we are going to disallow the expenditure, which is a very harsh approach. And one silver lining we have is the explanation says, though you have not earned, received, or accrued the exempt income during the year, you should have incurred expenditure against such exempt income during the year. If at all the incurring of such expenditure has not happened, then there is no way this explanation can be applied. This is where the assessee, the taxpayer, must demonstrate if at all there is no incurring of expenditure against such source of income, then definitely he must be in a position to canvass and demonstrate that there is no incurring of expenditure also, which can really bail him out from the application of the new explanation inserted. And then let us quickly go to the COVID treatment and the medical treatment, the exemption. If you remember, in the month of June 2021, there is an announcement that has come from the from the board that they are going to exempt the amount of expenditure which has been funded either by an employer in the case of an employee or by any other person, giving it to the the assessee or a taxpayer who is a patient of the COVID treatment or his family members. The provisions have been drafted in such a manner 56(2)(10) has been amended so as to provide that any amount received by an individual from any person in respect of any expenditure actually incurred by himself on his medical treatment or treatment of any member of his family. So if he has incurred on himself or for the purpose of treatment of any member of his family, any amount received from a person would be exempt from tax. It's not going to be treated as a taxable receipt. That is what is a very heartening thing, which is being made a retrospective effect, amendment from 1st April 2020. There is one more dimension to this exemption. If at all, unfortunately, if the taxpayer passes away on account of COVID illness, then any of his family members of the deceased person receive from the employer of the deceased any amount, there is no limit, as an ex gratia, that's not going to be taxed in the hands of the family members. Such exemption is also there if at all the the income comes as an ex gratia payment from any person other than employer, but there you have a limit of 10 lakhs. And that should have been received within 12 months from the date of death of such person. And the person should have died on account of illness relating to COVID-19. This is what are the conditions, and this is a welcome proposition. And when you talk about member of the family, you will have to refer to the definition of the family given in explanation 1 to section 10, subsection 5. If you go there and see what is the definition, the family consists of spouse, if at all it is you're talking about the husband, wife, children, and brothers and sisters who are dependent on him. That is what very important. And in fact, 10.5, 1 minute, I'm going to 10.5 straight away. And 10.5 also talks about parents, obviously. Parents, brothers and sisters of the individual, or any of them wholly or mainly dependent on the individual. So, brothers and sisters of the individual, or any of them wholly or mainly dependent on the individual. That is very important, which you need to bear in mind. Then let us quickly get into the explanation 3, expenditure prohibited by law. Section 37 is always an omnibus provision in the computation of business income in chapter 4D, which deals with section 28 to 44. That is where you have an omnibus clause, whichever expenditure which is not fitting into the specific clauses of 30 to 36 will come and sit in 37. And there have been instances where some gifts, some compliments, and some vouchers are being given by the pharma companies to various doctors to promote their products. That is the tablets or any sort of formulation product, let it be a tablet or an injectable or whatever it is. So it was, there is one regulation which governs the medical profession. That is Indian Medical Council Professional Conduct, Etiquette and Ethics Regulation 2002 bans or puts an embargo on any such gifts or compliments that can be accepted by medical practitioners from the pharma companies. So it is definitely whatever you receive is against the public policy. That is what is the inference drawn by the government now. And this is one dimension which they would like to address. And then there are plethora of rulings on this issue stating that the Medical Council Code of Conduct for the medical practitioners cannot in any way impact the allowance or disallowance in the hands of the pharma companies for the purpose of income tax law. And many tribunal decisions went in favor of the pharma companies who have claimed such gifts given or vouchers given to the medical practitioners as their expenditure under section 37. So there are also for and against judgment. There are some judgments which have told that this is against the public policy and it cannot be given. And then to discourage the claim of such deduction of which is now an offense, there is one more dimension which has been brought in the section, the new explanation 3 which has been inserted. You are a multinational company having your presence in various countries, and then you have violated some law in the foreign land, not in India. We all know that explanation 1 to section 37 has come way back in 98. When Pranav Constructions case was decided by the Honorable Tribunal in the Mumbai Tribunal, where Pranav Constructions, being a builder, claimed extortion money paid to gangsters as an allowable expenditure to do the construction business in a smooth manner. And in fact, when it was disallowed by the assessing authorities, tax authorities, then the SSC has gone right up to the tribunal where in the Pranav Constructions case, tribunal allowed such amount of extortion money as a expenditure, allowable expenditure in the hands of the SSC, which is definitely against the public policy. Immediately, the then succeeding finance bill, the government brought an explanation 1 which says you cannot make any payments which are against the public policy, and that is already there in explanation 1. But when we talk about the public policy and we talk about any such payments, it is always confined to the 4 corners of this country. But now there is an expansion or an extension of this rule even to the foreign land. This is very, very surprising. How you can look at this, how you can decide what is a violation under the foreign law is an issue of discussion, because you can't sit in judgment and decide whether that particular payment is against the violation of the law in that country. Because when we talk about violation of law, especially in this context, if at all you are paying a penalty, or whether you are paying an amount as a compensatory exercise. So this is where we have an approach which we need to decide whether the payment made by a taxpayer against a particular offense, whether it is compensatory in nature or whether it is whether it is compensatory in nature or whether it is penal in nature, needs to be analyzed. If at all it is compensatory in nature, it needs to be allowed as per the ratio laid down by the Supreme Court in various judgments in the past. If at all it is penal in nature, then the same would be disallowed, because that is against the public policy, because that is against a violation of a particular provision of law. So this is where how you decide what is penal in nature and what is compensatory in nature in respect to an offense committed by a taxpayer in a foreign land, which is always a debatable issue. But explanation 3 is going to cover even that one. And then expenditure incurred for any purpose which is an offense under which is prohibited by any law in India or outside India, I mentioned, provide any benefit or perquisite in whatever form or to a person, whether or not carrying on business or exercising a profession, and acceptance of such benefit or perquisite by such person is in violation of any law or rule or regulation or guideline, as the case may be, for the time being in force, governing the conduct of such person. That is what I have mentioned about medical practitioners receiving benefits from the pharma companies. And even if you compound an offense under any law for the time being force, either in India or outside India, you will have to disallow that expenditure and you can't claim it. All through corporates have been, rightly so, claiming any such expenditure incurred outside India for their carrying out business outside India is being claimed as an incidental expenditure, which is being allowed. Now that is to the dislike of the government, and now they have come out with a explanation which says even if it is in the foreign land, any offense committed and thereby any payments you make will be disallowed. But here again, I would definitely say the concept of what is compensatory in nature and penal in nature survives, and you need to demonstrate, if at all the payment made by you or is in the form of compensatory, is in compensatory nature, then you can definitely claim that to be a deductible expenditure as against a payment of fee or penalty which is penal in nature. This is what we need to bear in mind. And the case laws confirmed are this plethora of case laws. These have been confirmed. In these 3 cases, it has been held by the honorable benches of the tribunal that this is against the public policy and should not be allowed. Whereas in the other case law of Aristo Pharmaceutical, PHL Pharma and all that, more so in the context of medical practitioners receiving gifts and vouchers from the pharma companies to promote their product, is all to be allowed as an expenditure in the hands of such pharma companies, including Eli Lilly and Company, the Delhi Tribunal, and Dupin Laboratories. So all this case law is now overruled, and any such payments now being made are going to be disallowed in the hands of the pharma companies. And then there is a long debate what is happening about the SESH, that is higher education cess, whether it is to be treated as an additional surcharge, whether it is to be kept on par with tax payment so as to be disallowed when it is paid by the taxpayer. Some of the taxpayers have taken a view that cess is not in the form of tax. This needs to be allowed as an expenditure in the hands of the taxpayer, unlike tax and surcharge. What you pay as income tax and surcharge, fine, it would get covered by the disallowance under 40A2, but not this. That is the argument taken by some of the taxpayers before the courts of law, and some of the courts have given judgments in favor of the SSEs, stating that cess is to be allowed as an allowable expenditure. For the basis for that is CBDT circular issued in 1967, where cess is allowed as an expenditure under 48. However, cess as referred to in the circular refers to the cess imposed by the state government and not the central government, more so in respect of this higher education cess. So this is where revenue has a different approach, and it argues that the circular covers only the cess that is being levied by some of the state governments, which is to be allowed, as how you allow sales tax in the past, now GST in the present as an expenditure. That is what is levied by the state governments. Now you can't allow a cess which is levied as part of tax as an allowable expenditure. That is the argument of the revenue. But of course, most of the courts went in favor of the SSE, holding that cess is an allowable expenditure. But definitely, this is a very far-fetched claim. All of us know that this cannot be claimed as an allowable expenditure because it forms part of the tax payment. And there is one judgment delivered by the Honorable Supreme Court way back in case Srinivasan's case, where they have clearly heard that cess or any additional tax, it is to be disallowed, and it sits in the broader spectrum of taxes only, which is to be disallowed by 48(2), and it cannot be allowed as an expenditure. And K. Srinivasan's Supreme Court judgment has been relied upon by some of the tribunals, who have taken the view that this should not be allowed. And in fact, case laws overruled in these cases. Bombay High Court, Rajasthan High Court, and Delhi Tribunal, Kolkata Tribunal have ruled in favor of the SSE, stating that cess is an allowable expenditure, which as Kanoria Chemicals, Kolkata Tribunal relied on K. Srinivasan's judgment. That seems to be the correct approach, because Srinivasan's judgment of the Supreme Court was not looked into by all these judgments listed above. Thereby, the ratio of those judgments is now overturned or neutralized by bringing an amendment stating that cess is always a disallowed expenditure like income tax. That is what you need to bear in mind. And then conversion of interest payable into debenture or other instruments, section 43B. See, we all know that 43B, when it allows expenditure only in the year of payment, not in the year of accrual. That's all we know. And the interest paid to financial institutions and nationalized banks, cooperative banks, is also within the ambit of section 43B. Unless you make the interest payment, they cannot be claimed. So there are instances where the loan restructurings happen because of various business cycles that are faced by the business SSEs, companies and non-companies who are in business. If at all they face some tough times in the market and they lose out earnings and they incur losses, then in such a scenario, the repayments might not happen as per the schedule given by the institutions or banks. Then in that scenario, they may restructure the loan and converting the unpaid interest as loans. Conversion of unpaid interest into loans would not amount to actual payment of interest. It would not amount to actual payment of interest, though you may argue that it is a constructive payment. No. As far as 43B is concerned, you have specific explanations in 3C, I mean, 3C, 3CA and 3D are already there, which talk about conversion of loan, I mean, unpaid interest into a loan would not amount to actual payment of interest. Thereby, it would not be allowed for 3B. The same philosophy is now being extended to debentures, because the corporates are taking the route of conversion into debentures. If at all the unpaid interest gets converted into debenture, and whether such conversion of a debenture or any instrument, is it to be treated as an actual payment of interest? There again, the revenue is now taking a view, even such conversion of unpaid interest into debenture or any instrument would not be considered as actual payment of interest. Accordingly, the explanations, existing explanations have been amended to provide this new proposal of denying allowance, treating conversion as actual payment of interest. That is unpaid interest being converted into debentures or as any instrument, which will come into effect from 23-24 assessment year. One, I have some difficulty in moving this. These are the case laws that which got overruled, that is Aqua Technologies. In case law confirmed in the Gujarat Supreme, that is a Supreme Court judgment, Supreme Court took a view that definitely it would not amount to actual payment. This is what has been now, this is what has been now followed by the new proposal in the finance bill. And now loans are borrowing, source of funds of the creditors, section 68, which is a very, very surprising and the aggressive stand of the government. If at all you have a creditor, a loan or a borrowing taken by a taxpayer, definitely the loans or borrowing taken by the taxpayer would be credited in the books, and you have create a creditor's account, and you are under an obligation to explain the genuineness of transaction, creditworthiness of the creditor, and the identity of the creditor as per section 68. The Calcutta High Court judgment way back has laid down what are the three, the criteria that you need to follow. That is identity of the creditor, genuineness of the transaction, and creditworthiness of the transaction. These are the three dimensions which you need to establish to discharge the obligation cast on the SSE as per the provisions of section 68 cash credits. As you know, though the provision looks very simple, it is very deceptive. The section 68 has created enormous jurisprudence in our country. And definitely the onus is always on the taxpayer to establish these three criteria, which are prescribed by the Calcutta High Court in Shankar Industries case, way back by the Calcutta High Court. That has been religiously followed by all the taxpayers to discharge their onus of proof under section 68. But now, always the judgments have given, even the Supreme Court ruled that source of source need not be established by the SSE. Suppose I take a loan from X. X is a regular taxpayer, and his identity is established, his creditworthiness is established, and genuineness of the transaction has been established because the loan is taken through banking channels. So what more I need to establish to prove that this credit is genuine? That is where my discharge of onus ends and closes. But unfortunately, there is one explanation which was already brought in the statute book with respect to the share application. Stellar Investments and all that Delhi High Court way back, that is almost, I'm talking about 20 years back when I started budget lectures, we had Stellar Investments case at the Delhi High Court, and wherein it has been held, when once you identify the share applicants, that is good enough. You need not have to prove their sources. That is what is very, very practical. But unfortunately, in section 68, we have an explanation which is already sitting in the provisions from last few years, which I will tell you. Section 68 talks about provided that where the SC is a company not being a company in which the public are substantially interested, and the sum so credited consists of share application money, share capital, or share premium, or any such amount by whatever name called, any explanation offered by such SSC company shall be deemed to be not satisfactory unless the person being a resident in whose name such credit is recorded in the books of also offers an explanation about the nature and source of such sum so credited. Such explanation, in the opinion of the assessing officer aforesaid, has been found to be satisfactory, provided that nothing contained in the first proviso shall apply in person in whose name the sum referred to there is recorded is a venture capital fund or a venture capital company. So what they have done, this proviso has come inserted by 2012 Finance Act. That is almost from 10 years we have that proviso, wherein an extra obligation is cast on the taxpayer to prove the source of source, especially in the context when you receive share application money from the prospective shareholders in the hands of a company. The same logic is now being extended even to the loans and borrowings. If you are extending the same logic to the loans and borrowing, that means the entire gamut of section 68 is covered. What more is left? Whatever you receive, you have to always prove their source of source. The Supreme Court said source of source is not to be questioned, but to neutralize the judgment. Now this one more, what you say, the finance will propose to amend so as to provide the nature and source of even the creditors who lend a loan or advance should be established. You are under an obligation to establish. You have to take his sources and prove in your file that he has got a valid source to give that loan to this taxpayer, which is definitely too much from a taxpayer being asked by the revenue. Now coming to the PSU disinvestments, Finance Bill 2022 proposes to amend section 79. You know, 79 operates in such a manner, if at all there is any change in the management, change in the promoters, the old promoters should continue to the extent of 51% of the shareholding and voting power. In such a scenario, the brought forward losses will be allowed to be carried forward and set off. If at all the then existing shareholders ratio of holding comes below 51%, then the carry forward of losses would not be allowed. This creates a stumbling block to PSU disinvestments also. So that is the reason there is an amendment proposed not to apply to an erstwhile public sector company, subject to condition that the ultimate holding company of such erstwhile public sector company immediately after the completion of the strategic investment continues to hold directly or through its subsidiary or subsidiaries at least 51% voting power of the erstwhile public sector company in aggregate. If at all there is a holding company to a particular PSC which got disinvested, that holding company's shareholding, that 51% ratio must be satisfied, and then the carry forward of losses would be allowed. In the year that it drops down, then definitely the carry forward of losses would not be allowed. That is to suit various PSU investments like Air India and other large disinvestments that are happening. This has been brought in. Wherever my voice or is not audible and all that, please let me know. Okay.
It's perfect, Prasad. Carry on.
Okay.
It's going well. It's going well.
You please stop me wherever it's not audible. Okay. Then no set off of losses against undisclosed income. This is another new provision that has been. See, the revenue, the CBDT or the I mean, the revenue is very, very always hungry in ensuring that new provisions are thrown against the taxpayers and new revenues have to be mopped up. See, you have unabsorbed losses being carried forward, even in the case of a taxpayer who is searched. What is wrong? See, I have unabsorbed losses being carried forward, genuinely incurred and quantified by the tax officer. If I have such a loss which is being brought forward, why should I be deprived of adjusting that against an undisclosed income which has been unearthed by a search operation or a survey operation or an operation in section 132A? If at all these three provisions apply and a particular income has been pulled out or unearthed as an undisclosed income, now the provision says, now the new proposal says that a taxpayer is not entitled to set off such undisclosed income against the brought forward losses, which is highly unjustified. And in fact, the deterrence is going beyond the normal proportion, beyond the normal expectations. See, from all sides, you try to corner the SSC, put tight restrictions that would only dampen the voluntary components. That is what needs to be understood, because that would go totally against the practical approach which needs to be adopted. See, now it says the definition of undisclosed income again is to, the undisclosed income means to include any income, bullion, jewelry, or other valuable article or thing, or any entry in the books of account, or other documents or transaction which is discovered in the course of search, which has remained unrecorded and has not been disclosed to PCCIT, that is the Principal Chief Commissioner or Chief Commissioner or Commissioner, or say before the date of search or reposition of search. Why do we inform the Principal Chief Commissioner that you have some disclosed undisclosed income? No one will do it. So if at all it is not done, then it becomes undisclosed. This is where again you need to rely on a plethora of case law decided in the context of block assessment, where you have a lot of discussion on undisclosed income before the courts of law. Again, you are going back to that case law and relying on that, whether a particular income being categorized as undisclosed income is truly an undisclosed income or not, for the purpose of applying this new provision of section 79A, disallowing or denying the set off of the unabsorbed losses. This is where again we are going to have a plethora of litigation that is going to come up. This is applicable from 22-23 assessment year. Then national pension system. Then national pension system, state government employees have also been brought on par with central government employees. As you know, central government employees, the contribution by the central government up to 14% is deductible in the hands of the taxpayer, the central government employee, by the central government. That is, government's contribution up to 14% is allowed as a deduction. Whereas, as of now, in respect of state government employees, the contribution by the state government only up to 10% is being allowed. Now it is being thought of bringing state governments on par with central government and allow 14% even in the hands of state government and correspondingly in the hands of the state government employees. This is retrospectively from 2020, 1st April. And annuity to a disabled person, section 80DD. 80DD provides that the deduction shall be allowed only if the payment of annuity or lump sum amount is made to the benefit of a dependent. A taxpayer has got a dependent who has got a disability, a physical disability, and he is making annuity payments to take care of such dependent after the lifetime of the parents. Generally, the annuities would be paid in lump sum, after the demise of the parents who have contributed for such policy. That is for the, maintenance and other expenditure of the disabled dependent. And in fact, Justice Sikri, the honorable judge of the Supreme Court, in one of the cases, he retired, Justice Sikri retired, when he was a Supreme Court judge and when he ruled a case in the case of Ravi Agarwal, it was observed that there could be harsh cases where handicapped dependents may need payment of annuity or lump sum basis even during their lifetime of the parents, because the parent is able to contribute to the annuity and create a fund for the dependent so as to take care of his maintenance after the demise of the parents. Because the parents, as long as they are alive, they are incurring expenditure and taking care of the maintenance of the disabled dependent. There could be instances where even the parents, when they retire and reach a particular superannuation age, definitely even their capacity or ability to incur expenditure would come down. That is the reason, if at all the annuity is maturing at the time of their retirement, that was taxable in the past, but now that is made non-taxable, even if the annuity is received in a lump sum amount, even when the parents were alive, but only after they reach an age, and whoever is subscribing the annuity should have reached the age of 60. And the payments, the subscriptions should have been discontinued from that year. That is the condition. That's a good proposition. And they have also taken care of a situation, if at all the annuity is received during the lifetime of the dependent, it should not be taxed. And there could be instances where the tax was levied, if at all the parents passed away and it is received in the hands of the dependent, even then it should not be brought to tax. That is the new proposal, and it has been clarified beyond doubt, and this is a welcome proposal. And then coming to the startups, extension of the incorporation date is very, very critical. For an eligible startup, there are certain conditions of the turnover and when you have registered the company. As per the present provision, if at all you are not registering your company as an eligible startup on or before 31st March 2022, the date is over. So such sunset date is being extended to 31st March 2023. It's a year extension is given because there is a lot of hope and a lot of pampering for the startups being done by the government, because we expect number of unicorns that would be developed by the Indian startups. That is what we are looking at. So as an exercise to promote the conducive atmosphere for startups, the incorporation date has been extended up to 23 March. And eligible startups incorporated, that is over now. 1 minute. And then the next slide is incorporation date. The startup is over. Now this is bonus and dividend stripping. This is aptly applicable to high net worth individuals who have started investing in real estate investment trusts, alternative investment funds, and also investment, the investment trusts also. And the Finance Bill 2022 proposes to amend 94(8) to extend applicability of the bonus stripping and dividend stripping to the units. Earlier, it was applicable only to the mutual fund units. Now it applies even to units coming from these three, that is business trust, investment trust, and real estate investment trust, and alternative investment funds. So if at all you invest in any of these funds, and the real estate funds have come in a big way, and even the FEMA regulations have been modified accordingly, and high net worth individuals who are investing into these funds, see, there is always a tendency that immediately after declaration of the bonus, the value would come down, you would sell and book a loss, and such loss is again set off against the profits of sale of other units. So this exercise is called bonus stripping, stripping, and this dividend stripping were there for the mutual fund units, but not for these units of these investment funds. Now this has been made applicable, thereby the high net worth individuals who have been availing this facility is no more available from the assessment year 23-24. And these are the case laws which got overruled. And then new manufacturing companies, you have got, again, the commencement of production is a critical point for you to avail, for a person to avail, for a taxpayer to avail 115 BBAB, which says you are taxed at 15% with some conditions that you should not take deductions under section chapter 6 and all that. So, this is all to promote the Make in India concept in a big way. So the commencement date as of now it's 31st March 2023. The unit should have started production on or before 2023. See, to give one more, in view of pandemic, in view of so many disturbances that have been encountered by the taxpayers and the eligible units, the proposed, the deadline for production commencement has been extended up to 31st March 2024, which is also a welcome proposal. And then dividends from foreign companies. This is where we need some little discussion. 115 BBD. What is 115 BBD? 115 BBD provides that you are an Indian company receiving dividend from a foreign company that is taxed at 15% provided you hold minimum of 26% capital in that foreign company. It could be even a wholly owned subsidiary also. Minimum is 26%. That's where you could be one of the joint venture partners. This is all an outbound investment. As you know, now India is fast transforming itself into an outbound investing country. It's a very heartening news. You have a lot of Indian corporates investing outside India. And so many multinational Indian enterprises are in the formation. Not only large corporate groups like Reliance, Birlas, and Tatas, even in the mid-sized corporate groups, you are seeing a lot of outbound investments happening in a big way. The globalization is taking place in a real manner, in a true manner. More so in the case of startup companies. See, the startup companies develop their business proposition on some technology front. Today, the Swiggy's valuation is mind-boggling. Today, Zomato's valuation is mind-boggling. And Paytm valuation is also really phenomenal. All these things are happening because they take the technology-driven propositions or the formula to develop their startup. You know, Flipkart was a case study by itself. Though it was continuously incurring losses, the valuation was put at $16 billion by Walmart. It has always incurred losses. Till such time, I don't know what it's doing now. But in spite of losses, then what for the valuation is so high? It is for the technology they have used, which has created a very robust network of consumers. That is for what Walmart has paid $16 billion. They are not fools to pay that much of amount to take over the company. Because Walmart is a global giant. Why I'm saying so, the outbound investments are also happening from the nascent infant startups also, because they want to expand their technology across the world and soon become a unicorn. So when you are investing abroad, that would incentivize, if at all, there is some dividend coming from your subsidiary to a startup, if it is taxed at 15%. See, way back in 2011, this was proposed by the then Honorable Finance Minister Pranab Mukherjee, who was then, and at a later point of time, he became the Honorable President of India. So the then Finance Minister proposed this, brought in this rule of a 115 BBD provision, wherein if you are getting dividends from a foreign company where you hold more 26% or more capital, then it should be taxed at a concessional rate of 15%. See, all through it was maintained. Now there is suddenly it's being withdrawn. There is one more development in between. Originally, this was put as a rule for 1 year in 2011. It got extended by 1 more year. It got extended by 1 more year. Then in 2014, when this BJP government came into power, the first budget presented in 2014 by the then Honorable Finance Minister Shri Arun Jaitley, he gave a comment in the Parliament in his budget speech stating that this provision has resulted in bringing a lot of funds back to the country in the form of dividends from the outbound investments. So there are encouraging developments which warrant for making this provision as a permanent provision in the statute book without a sunset clause. Till such time, each year it got extended year-wise. That's what I told you. So when it became a permanent provision, everyone would look at it as a feature which would last for years to come. Suddenly, I don't know why CBDT or the government or the revenue is looking at withdrawing this particular provision with effect from 23-24. The reasoning that is being given in the memorandum explaining the provisions is, when this provision was in the statute book, you never had any dividend tax in the hands of shareholders in India, because there was a dividend distribution tax under 115. Dividend distribution tax has been done away with in 2020. And now the shareholders are going to be taxed in their hands at the rate at which they are going to be assessed as per their income bracket, income slab. So to bring parity, we want to dispense with this 15% concessional rate and make it taxable on par with the domestic company dividends, which is not correct. Because the domestic company dividends can never be equated with the dividends what you are earning from foreign companies. You are taking all the risks that are associated in investing in a company outside India. That can never be equated with an investment within the country. Within the country, your effort, your risk parameters are totally in a different framework. So that is being compared. That is the reason for withdrawing this particular 115 BBD. And in fact, even FEMA regulations, there is an exercise that is, if you make an outbound investment, you will have to regularly, that particular company which makes the outbound investment has to file annual performance report, APR filing every year, which needs to be certified by a statutory auditor of the company. So APR is always tracked by the RBI to continuously monitor and see whether the outbound investments are resulting in repatriation of dividends back to this country. So all this has got a sacred purpose, and the 15% what is being levied should not be dispensed with a wrong comparison with a different dividend tax being implemented now in the hands of the shareholders in India. That is wrong. That is wrong. So that is the reason now there is an active representation. In fact, I wrote an article in Tax Sutra, which all of you can just have a look at it. We go into Tax Sutra. You will find my article on 115 BBD, where I explain this in detail and canvas for restoration of this particular provision. More so when we are giving all the support to startups. It would definitely impact startup. See, of course, we have ATM provision. What is ATM? You receive dividend from your subsidiary and you pass it on downstream to your shareholders, and whatever you receive and pass down, that's passed down in the same year as per the timelines prescribed by ATM. The cascading effect is removed and there is no dividend tax on that ATM. But it may not happen in the hands of startups. Startups at the parent level, at the apex level, that is at the headquarter level in India, they may be incurring losses. Some of the subsidiaries which they have created outside might create some profits which they have distributed as dividends. The same dividends, the parent startup in India would not be in a position to distribute to the shareholders, thereby they cannot avail the provisions of Section ATM. So ATM is not possible. ATM, of course, is amended from Finance Act 21-22 from last year. Even if you receive dividends from a foreign subsidiary and if it is passed on to the shareholder, you have the ATM benefit, and that particular dividend which is passed on would not be brought to tax in the hands of this company. That is to remove the cascading effect. But that will not happen in the hands of startup. So there is every justification for restoration of 115 BBD, at least keeping startups in view. And then you have virtual digital asset. This is the most important discussion for us today. What is a virtual digital asset? They have given, there is a definition that is given, which you need to see. (247A) is the new definition of the virtual digital asset. That is all the cryptocurrency. What we have been talking about in a big way from last 1.5 years. After the pandemic started, the cryptocurrency picked up, I don't know for what reason. And cryptocurrency operates on blockchain technology, as you know. That is called the multi-ledger technology. Created that particular technology operates the cryptocurrency. Now we have Bitcoin. Bitcoin is the trendsetter. You have host of cryptocurrencies now. Now there is what is the definition? This is the first time there is a definition that has come in the statute book. What is a virtual digital asset? As any information or code or number or token, not being Indian currency or any foreign currency. Indian currency or official currencies are not in this definition. Generated through cryptographic means or otherwise by whatever name called, providing a digital representation of value chain, is exchanged with or without consideration, with the promise or representation of having inherent value, or functions as a store of value or a unit of account, and includes its use in any financial transaction or investment, but not limited to investment schemes, and can be transferred, stored, or traded electronically. We don't know whether this definition is exhaustive, whether this is inclusive. It is very difficult, especially the wording which says generated through cryptographic means or otherwise, providing a digital representation of the value which is exchanged. So this is very, very tricky. So we do not know what can come and sit in this particular definition. It could be, as I have mentioned here, tomorrow one can argue there is one new technology that is coming up. Most of you would have studied, especially the youngsters would have studied definitely. That is metaverse. Metaverse will create a virtual reality is created where two persons, because the social media is now boring. They don't want WhatsApp, they don't want Instagram and all that. They want something more. So I am in India, sitting in Hyderabad, and my friend is in US. So both of us, we can virtually get connected and talk to each other in a 3D environment like thing, which will almost create a feeling that my friend is in front of me. That is what metaverse, and Facebook is pioneering to bring this technology in a big way. With my limited reading of this technology, I understood that this is not yet approved by Washington. That is, the US government is yet to give its clearance to promote this particular technology, because whether it has any ill effects, adverse effects, that is what they are trying to analyze. So there could be a scenario where so many new assets might come into, that is assets in metaverse, non-fungible tokens, and digital currencies. Of course, digital currency, if at all, it is an official currency, like what is announced by the Honorable Finance Minister, we are going to have a central bank digital currency in the near future. So what can come and sit in this definition is to be watched. We have to wait and watch. And then let us go back to this. As of now, the government has been sitting on this particular cryptocurrency. Everyone were keeping their fingers crossed whether there would be a ban on this, whether there would be a legitimization, whether there would be a legalization of this cryptocurrency. All these doubts were there in the minds of the crypto exchanges. The legitimization or legalization has not happened the way it was expected, but the tax rules have come to the forefront. The taxation has started. There is no way tax can wait. They don't want to lose on the tax. That's the reason the tax has come in the first place. It doesn't mean that these cryptocurrencies have been legalized, or it doesn't mean that cryptocurrencies have been legitimized. That is what has been categorically clarified by the Honorable Finance Minister in the press conference immediately after presenting the budget. Even the Revenue Secretary, Mr. Tarun Bajaj, has clarified this. So don't take it as legitimizing or legalizing this as a tender. No. In fact, RBI always clarified that this is not a legal tender. And in fact, RBI canvassed for a digital currency, that is the official digital currency, which is now becoming a reality in the near future. Be that as it may, then what are the tax laws that are proposed? The moment you sell a virtual digital asset, that is a cryptocurrency for our understanding, through one of the exchanges, Coin, CDX, or whatever you may say, Switch Kuber, so many things are there. 30% tax is going to be levied. Only the cost of acquisition can be reduced, nothing else. No expenditure, incidental expenditure, nothing. If at all it results in a loss, you have to suffer. There is no way you can adjust this law against any other income you earn in the year. Thereby, it is a watertight compartment charging provision under section 115 BBH, which is a new provision. There is no way it would be allowed to be intertwined with the other streams of income. That means a loss incurred on a virtual digital asset cannot be adjusted against income you made on the other share gains and other things, whatever gains. No long-term gains. Whether it is long-term or short-term, it has no relevance now because the highest rate is applied. And no set-off or carry forward. Now there is one doubt. If you go to the 115 BBH, which is very interesting. I don't know how much time we have, but
Prasad, carry on. No, how much more you require?
No, I require another half an hour. That will do for me.
That should be comfortable, Prasad.
Okay. So the 50, clause 28 of the finance bill talks about 115 BBH, the new charging provision of the virtual digital assets, which says, notwithstanding, the first provision says where the total income of an SSC includes any income from the transfer of any virtual digital asset, the income tax payable shall be the aggregate of, that is 30% tax would be levied on this gain made on virtual digital asset, which is a compartment by itself, which will not clubbed with any other income. The other income will get taxed as per the normal provisions and normal tax rates, depending on the slabs. The subsection 2 says, notwithstanding anything contained in any other provision of this Act, no deduction in respect of any expenditure other than cost of acquisition. Thank God, at least cost of acquisition is allowed. Or allowance or set off of any loss shall be allowed. That means no deduction in respect of any expenditure other than cost of acquisition, or no allowance or set off or any loss shall be allowed to be allowed to the SSC under any provisions of the Act. Under any provisions of the Act. That means there you are including even 115 BBH also. Why I am saying so, I will explain. On one particular virtual digital asset, you made a gain of 10 lakhs. And another investment you made incurred 5 lakhs. You went into one cryptocurrency here, Bitcoin. You went into another cryptocurrency, there you have lost 5 lakhs. Whether you are allowed at least to set off these two, which are virtual digital transactions. They are not different transactions. At least in the same compartment, you must allow gain and loss set off. At least that must be allowed. Some experts are of the view that subsection B, not subsection, that is clause B of subsection 2, 115 BBH is facilitating them. What does it say? No set off of loss from transfer of virtual digital asset computed under clause A of subsection 1 shall be allowed against income computed under any other provisions of the Act, any other provision. There in A is talking any provision, here it is any other provision. That means I can conveniently say, when I am in 115 BBH, any other provision is not allowed. So I have loss in the same provision. So I must be allowed to set off. So that is where a particular argument is doing rounds, that virtual digital asset loss can be adjusted against virtual digital asset gain. But we have to keep our fingers crossed till proper clarifications come. Then 194S has been brought, very, very cleverly now. 194S says, in order to whiten the tax base from the transactions, even CBDT Chairman Mr. Mahapatra has been giving press conferences from last 2 days only on this. He has categorized all this 10 crore probable number of investors in India into 4 categories. He says some people are not declaring at all, some people are declaring partially, some people are taking adjustments against the other income. So many things, so many categories. So we are going to track them and bring them to tax. In order to widen the tax base from the transaction in relation to these assets, proposes to insert 194 as a new TDS provision, which casts an obligation on the person at the rate of 1% on the payment for transfer of virtual digital asset to a resident. It is only talking about the resident. If you are an NRI, you are not covered. A resident transferring his cryptocurrency through a crypto exchange, who is now cast with the obligation to deduct taxes? It is the crypto exchange is under an obligation to deduct 1%. So it's a very clever move, because it is not the seller who is selling the cryptocurrency. It is not the buyer who is paying and who is under an obligation to deduct tax, but it is the exchange which is facilitating the transaction should administer this TDS 194S. When there is a discussion about 194, there is also a discussion about 194O, because e-commerce platform transactions, we have a provision under 194O. There also, if I'm not wrong, it is 1% there. So if there is an overlap of 194O and 194S, now the law says you have to get governed by 194S and not 194O. 194O has got a linkage with equalization levy. There is an overlap between equalization levy and 194O, which we need to discuss separately in a separate session, not now. But 194O can overlap with 194S now, and 194S has to be applied. That is what is clarified. And who are the specified persons who who have some sort of relief or exemption? If at all a HUF for individual, he is under an obligation. That means if he is running the crypto exchange and he becomes the specified person and he carries out the transaction as a facilitator or an aggregator, then if his income, sales, receipts are not exceeding 1 crore, and then and the income from profession not exceeding 50 lakh, then that specified person need not have to comply with this 194S. That is what is the exemption. And then all other people have to necessarily follow this particular tax deduction account, that is the not tax deduction, TDS provisions have to be complied with. This is coming into effect from 23-24 assessment year. Okay, that means, am I tax free up to 31st March 2022? Because the previous year for assessment year 23-24 starts from 1/4/22. That means whatever transactions you do from 1/4/2022 is going to be covered by the new provisions of 115 BBH. Then can I take a convenient stand and say that whatever I sell now, I will rush and sell everything and make a profit and I'm tax free? No, that is clarified by the severity chairman. Nowhere you are given an exemption. You will be governed by the present provisions. Probably you can take what is long term, what is short term, and where probably you may be allowed to set off against the other loss, other gains from the other streams of income, like long-term capital gain on shares and all that. Probably you can do that. As per the present provision, you have the facility up to 31st March 2022. From 1/4/2022, the new tax regime will take over. So here, quickly wrapping up this discussion, which is very interesting, 6 lakh crore Indian rupees, that is the statistics reveal, is held by around 10 crore Indians as of now. 6 lakh crore Indian rupees is involved in cryptocurrency investments. There is a spurt in trading values after the taxation announcement. Probably they are all happy now. At least there is some sort of legitimization. You have identified this as a digital asset. That is good enough for us. There is no ban. That is what they are telling. And that is the encouragement and that is the emboldenment they got from the announcement. But government said, just because we are taxing, it doesn't amount that we are legalizing. They have not legalized, they have not legitimized, but at the same time, they have not banned. That is what you need to remember. CBDC, that is the central bank digital currency, is going to come into play. Digital rupee is going to be there, which can be exchanged with real currency. That's not a problem. That's what even Honorable Prime Minister clarified in one of the meetings on the economy immediately after budget. And the transactions up to 31/3/2022 will be governed by the existing tax regime. That is what some experts feel, that crypto losses can be set off against crypto gains. That is what I mentioned, even when the new regime starts, as per the subclause 2, which I have read of subsection 2, B of subsection 2. And then whether this income is legal or illegal is not required for the purpose of taxation. Way back, Honorable Supreme Court clarified in Pyara Singh's case, though a taxpayer earns illegal income, there is no exemption for that from the tax point of view. It has to be taxed. He may be punished under a different law, that is different. Just because he is being punished there is no exemption of tax for the illegal income earned. Pyara Singh's case is there. So whether income is legal or illegal, it is going to be taxed, whether it is now or in future. Then there could be an overlap with, again, equalization levy 2.0, because some of these transactions which are virtually happening can overlap with equalization levy 2.0, which are going to tax a non-resident e-commerce operator. Whether a virtual currency, a crypto exchange being operated by a non-resident, whether the transactions can overlap with the equalization levy provision is a issue by itself. And the definition is very complex, and all this I have explained. And now we don't know, because of this rush of selling before 31st March 2022, the values may further dip. The Bitcoin, which is the trendsetter in these cryptocurrencies, was valued around $68,000 in November 2021, which came down to $30,000. I don't know the present value. It might have gone down further, or it would have picked up. I don't know. This is how they are going to fluctuate, and we are going to see something new that's going to come up in 2022 in all respects with respect to these virtual digital assets. And then updated return is the most important thing on which we need to spend some time. Updated return is a new concept that has been brought in. a very new concept. We know about the return being filed on time, that is the original return. We know of belated return, which is being filed under 139(4). We know of revised return under 139(5). Kumar Jagdish Chandra Sinha's case, Supreme Court said, revised return can be filed when within the time prescribed, and that has been legitimized by the ratio laid down by the Supreme Court in Jagdish Chandra Sinha's case. Now, updated return. What do you mean by updated return? As you know, the timelines for filing these returns have been brought down drastically. So you have limited few months time available even to revise the return under 139(5). That is the reason now annual information system is the order of the day. All your financial transactions are being captured. Even when you are filing return for your claim, you are checking EIS thoroughly and ensuring that no transaction is missed out. So that is the reason EIS is a mirror available, which is showing all your activities, and the revenue has got all the data with them. So there is an opportunity being provided to the taxpayer to come up voluntarily on his own and file an updated return. This would greatly facilitate the tax department in avoiding, no, I wouldn't say avoidance, in avoiding issuance of 148 notices, 147 notices. That is reassessment. So it is a new window, which is very, very interesting, very welcome. You are provided with the provision of updated return. There would be a new form which you can, when you can file it, within 2 years from the end of the assessment year. Suppose you are talking about 21-22, let us say. 21-22 assessment year is coming to close now. That is March 31st, 2021 is getting closed assessment. From there, 2 years. That means on or before 31st March 2024, you have an option to file an updated return. Of course, the very amendment is applicable from 23-24 assessment year. I'm just giving an example. A person shall not be eligible to furnish an updated return if a search has happened under section 132 or 132A is involved. That is the seizure of bullion, jewelry, and other things. Survey has happened at 133A, except TDS survey. That is, TDS survey is covered by subsection 2A. Notice has been issued to the effect that any money, bullion, jewelry, or any books of accounts seized or requisition in the case of any other person belongs to this taxpayer. In all this situation, you are not entitled to file an updated return. Also, you cannot file an updated return if there is an updated return already. That means you cannot revise your updated return. You can file updated return only once. Proceedings for assessment, reassessment is pending or completed. These are all the situations where you are excluded from filing updated return. That means an assessment is pending, a faceless assessment is pending. Already a notice is received, you can't. Reassessment notice, 147 notice has come, you can't. When that is pending, as long as it's pending or completed, then both situations you are not allowed for a updated return. And AO has communicated possession of information under the Prevention of Money Laundering Act. The assessing officer has informed the taxpayer, Baba, you have committed certain offenses under PMLA, that is Prevention of Money Laundering Act, which is a very draconian law. You have committed some offenses, so you are not entitled to make any updated return. Once he informs you, that is good enough, you are not entitled, you are deprived of making any updated return. Information under agreement under section 90, 90A received a communicate. That means exchange of information as per the double taxation avoidance agreement. Now the exchange of information between countries is happening in a seamless manner. That is what I have been telling in some of my lectures. One has to be extremely careful with respect to the cross-border transaction. Gone were the days you can think comfortably that whatever I have done in the other country in Singapore cannot be known here. No, everything is going to come to the knowledge of the taxman because the exchange of information has been facilitated in a big way. Even the Swiss bank is under an obligation to release the information of the account holders, which it has done in two or three tranches till now. Because even Switzerland has accepted the exchange of information treaties. And then prosecution proceedings are pending. No, you are not entitled to make an updated return. And or for any particular category of persons as specified by the board. So updated return shall be treated as defective unless supported by as a tax challan 140B. So at what rate you are going to pay? Let us just see. You will be paying at the rate of 30%. That is the, there is normal tax you will pay. Normal tax you will pay along with interest, and you will have to pay an additional tax of 25% if at all you are filing the updated return within 1 year from the end of the assessment year. The maximum time is only 2 years. If it is beyond 1 year and before the close of second year, then it is 50%. So this must be paid in full, and then that 140B should be attached along the updated return. Then only your return is valid. And these amendments are going to take effect from 2022. These are all the procedural matters. Procedural matters will take effect from 1/4/2022, whereas the updated return 139(8)(a) is possible from the assessment year 23-24, because it is very clear that this amendment will take from April 23. The return you can file from 23. That means the financial year 22-23 is the year against which the procedural facilitation has been made, and for the purpose of tax payments and other things and interest calculations and all. And this is a very important facility and a window created in line with large-scale computerization and the income tax portal functioning or not functioning as of now with some glitches. Be that as it may, let us hope and be positive that it becomes functional in a fit manner. And this is the order of the day. Your annual information system, annual information statement will give the entire jataka of the taxpayer. So there is no way you can slip or skip or intentionally avoid declaring a particular thing. Be very careful. One important clarification which has not come on updated return is, okay, you are giving an opportunity to me before any reassessment notice was given, 148 notice was given. I myself am filing an updated return. Would I be exempt from penalties? Would I be immune from concealment penalty under section 271(1)(c) or 270(A) reporting or misreporting? No clarity on this. The government is silent on that. So that is where we need a lot of clarity. Because they can always initiate the penalty proceedings and say, this was not declared in the original return. This was not declared on your own on the revised return. Hence, in the updated return, what you are giving, the penal proceedings can still haunt you. If at all penal proceedings are going to haunt you, there is no charm for this updated return. Let us all make a strong representation that the penal proceeding penalty should not be levied against submissions under updated returns. Because you have created a lot of restrictions. It is not that everyone can go and file the updated return. Not every assessee, because who are already covered by PMLA and other offences they are not given this facility. One who is honest, one who has honestly missed something through an inadvertence must be allowed to take advantage of the updated return, and penalty should not be levied. That should be the representation what we have. Faceless assessment. Now the faceless assessment has come up in a big way from August 2020. The scheme has come from 21. The very, the 144B has come into the statute book. You all know how faceless assessments are happening. There is compromise of principles of natural justice. Today you are sent a notice by the faceless system, and you are asked to submit the details within a very short time of 1 week or 15 days. There is no window for extension sometimes. Your plea for extension has been ignored because it is being taken up by the system. The system might recognize your request or might not recognize, I do not know. So sometimes the assessment orders are passed without giving proper opportunity of hearing, representation, and all that. That is where you have plethora of cases, right from Ekambaram Sukumaran to Telangana High Court's judgment in one of the windmill cases. In all cases, the Honorable High Courts have quashed the faceless assessment as non-est in some cases, stating that it has violated the principles of natural justice. That means you have not given sufficient opportunity for the taxpayer to comply with. And the very faceless assessment scheme under 144B itself provided that if at all the assessing officer or the assessment unit doesn't follow the procedure prescribed under 144B, the orders passed will become non-est as per subsection 9. That is very dangerous provision. So that on the basis of which number of writ petitions have been filed. In Parag Kishore Chandra Shah's case, the Bombay High Court has quashed the order passed by the faceless assessment scheme and levied costs, that is a fine on the assessing officer under the faceless scheme. So that is where the revenue is really seized of the matter. And that is the reason the entire 144B has been revamped with new provisions. Of course, new provisions are more or less the same, except some few changes. They have a review unit, they have a technical unit, they have an assessment unit. There is no interface with any officer. All communication should happen in the electronic mode. If you request for a hearing, it should happen in the virtual mode. A virtual hearing would be facilitated. Maximum time as per my knowledge is 30 minutes, or a video telephony through phone. It will happen not beyond that. And there would be a draft order issued. If you are contesting the draft order, you must file your objections. If at all such draft order is covered by the provisions of 144C, where transfer pricing implications are also there, you can go to the DRP. If you are not covered by as an eligible SSC by 144C, you can't go to DRP, and you will make the objections to the faceless assessment scheme system only. And if your objections are well taken, you may not have adjustment. Otherwise, an order will come with an adjustment. Then you will have to go into the appellate process. Here, there is one provision that has been brought here which says, having regard to the nature and complexity of accounts, volume of accounts, doubts about correctness of accounts, multiplicity of transactions in account, or specialized nature of business activity of SSC and interest of the revenue, assessment unit may, upon recording the reasons in writing, request National Faceless Assessment Center to invoke the provisions of section 142(2)(a) by forwarding the case to the jurisdictional principal chief commissioner or principal commissioner. If such request is not accepted, the AU unit itself will pass the order. And that means they are creating a window whereby in fit cases, large cases, suppose you are dealing with a case like Infosys or Reliance, where you need some more verification has to happen, then probably that may go into an exception list. We do not know, because we have heard last year some press notes and all that where Honorable Finance Minister is taking views across the country from the taxpayer community and the association and trying to create a selective window for few cases. There could be some hearings in person, or we do not know. So that is, there could be a hybrid with a judicious blend of faceless in majority cases and maybe in-person hearings in few cases. We do not. I'm not telling in a conclusive manner. That is the expectation. And even this particular edition in the 144B gives a lead to such inference. Okay. So this is what has been the development of the 144B assessment. That subsection 9, which is really really dangerous for the revenue authorities themselves to operate. That is, if they do not follow the procedure even in the smallest manner, then the whole proceedings will become non-honest and the order will become non-honest. Once the orders become non-honest, there is no way the proceedings can be revived. There is no way. That means that is the end of the story. So that is the reason subsection 9 has been dropped. Then you come to the faceless TP assessments. In fact, transfer pricing assessments, DRP proceedings. 1 minute. Transfer pricing proceedings and DRP proceedings. Anyhow, CIT appeals has already become faceless, but I think some more instructions have to come. They are waiting for that, but it is already faceless. Except international taxation and TP appeals are heard personally. DRP, TP, and even they have proposed in the last year's budget, if you remember, even appellate tribunal, income tax appellate tribunal will also become faceless, but there is a lot of representation. Because tribunal being a civil court, and a lot of representation has gone from the legal fraternity, not to make it faceless. And that is the reason now all these three portions have been put on hold. TP proceedings, DRP proceedings, and ITAT. These three will go on as per the existing approach of personal hearings till 2024, by which time they will take final decisions. That is what you need to bear in mind. And coming to the reassessment, last year itself, we had the revamp of provisions. 153A to A onwards, whatever provisions we have up to D or E, all that has been dispensed with. That is, the search assessment have to happen under 148 provisions only. And now a new 148A provision is created. In the normal circumstances, that is cases other than search and survey cases, 148A is a new provision created wherein pre-notice hearings would be conducted by the AO or the faceless scheme. Now even reassessment is faceless only. Reassessment is faceless, best judgment is also faceless. Penalties are also faceless. So there would be an exercise of examining whether it's a fit case for reassessment. In such approach, there would be a hearing notice and the SSA has to respond giving details, and then there would be an order passed why it is a fit case for issuance of 140. This is not required in search and survey cases and the notified cases. Notified in the sense as specified by the provisions as exceptions. And 149 is the time limit, you know, the 3 years time limit. The 3 years time limit, and again it is 10 years. Earlier it was only 6 years for everyone. Now it is 3, and 3 is, you cannot be so joyous that it is 3 years, because in many cases it will become 10 years. When the escapement of income happens to the tune of 50 lakhs or more. What is 50 lakhs today? It is nothing. If it is more than 50 lakhs, most of the cases will be reopened for 10 years. So against this, there is no Last year itself, this entire new regime has come. Except a few facilitating changes, there is not much that has come in 148 or anything. They have widened the scope when they have reopened, like if they receive information as exchange of information from the other countries, and if the information is making available through 135A, faceless collection of information is there under section 135A. There is some sort of discussion here happening. The faceless collection of information at 135A cannot be a source for reassessment. That is what is the opinion of some of the experts. Be that as it may, let us see that that is also one of the criteria for reopening. And then also to be treated as information for the reference to 3 years preceding the assessment year is omitted. So they have made certain cosmetic changes, and they have given in the earlier provision that the assessing officer, that is the faceless scheme, should take approval of the higher authority or the specified competent authority, specified authority for everything. If at all an approval is taken originally for 148A proceeding to decide whether it's a fit case for reassessment, that is good enough to issue a notice. For issuing notice, again, you need not take an approval. Like that, some relaxations have been made with respect to approvals, where a broader approval is taken. Approval need not be taken at every stage of the proceeding. And then 148B is also a new section. No orders of assessment shall be passed by AO below the rank of the Joint Commissioner. That is fine, unless it is approved by with the prior approval of the additional CIT. That means even a DC can pass an order. DC rank can pass an order with the monitoring of the additional CIT, with the approval of the, which is already there now. So these are some of the changes, cosmetic changes that have been made. But one issue which was bothering our minds is, you would have seen a lot of judgments coming from the honorable high courts, especially from Rajasthan High Court, Delhi High Court, recently in the month of January, if I'm not January, I think it is in December. Delhi High Court has come up with a very, very instructive judgment where they have quashed as many as 1,200 reassessment notices. Same thing happened at Calcutta High Court. That is all what has happened. The new scheme of reassessment has started from 1/4/2021. All assessing officers under the faceless scheme have gone issuing notices after 1/4/2021 on the basis of the law pre-existing in the old scheme. You can't do that. If you are doing that, they have given their own interpretation on the basis of taxation laws amendment and all that. That is 2020 Act. All that approach of revenue has been set aside and rejected by the honorable courts. And they said, you cannot, all those notices have been quashed as invalid, as non-est under the law. There was a lot of apprehension that the revenue, that the government would bring in some transition clauses to make their notices valid again, even though they follow the old law in the present regime. But that is not done. Thank God, nothing of that sort has been done. It is only the cosmetic changes that have been made to reassessment regime under the new approach, which is effective from 1/4/2021. I think already we are at 1:10. You tell me, we have another 10 slides to go.
Yeah, Prasad, there are also about, in fact, 28 questions were there, which I pruned to 18 questions.
Then what I will do, the balance I will quickly run through in just 3 minutes.
Yes, Prasad. That would be great.
Some slides I might skip also.
Right.
So that I will just brief them very briefly, and so that the audience can go through this presentation at their leisure and look at the law. Okay. So they have brought in a concept of avoidance of appeals. This is 158AB. Earlier we had 158A, repetitive appeals. And that has been repealed, and 158AB new provision has come, which is a welcome provision to avoid, because the government is looking at reducing the litigation. If a particular appeal is in favor, is decided in favor of the SSC, and against which the revenue has gone to High Court or tribunal, and if it is pending, High Court or Supreme Court if it is pending, then they are not going to file similar appeals on the similar identical points. So that is one thing which you need to bear in mind. And then business reorganization, that I can skip 194 IA. This is where this is a popular provision where if the immovable property is transferred, the buyer is under an obligation to deduct 1% tax. He need not take TAN number or anything, but he should deduct 1% while making payment to the seller under 194 IA. If the value of the property exceeding 50 lakhs, other than agricultural land. Here, there is a question which needs to be addressed. Sometimes the value is what you have quoted in the document is lesser than the guideline valuation, the stamp duty valuation. So you will have to take whichever is higher. Suppose the stamp duty valuation is higher, then this 1% should be deducted on stamp duty valuation and not on the amount paid as mentioned in the sale deed. Whichever is higher should be followed. And then you have benefit or perquisite more than 20,000, you have to make a TDS. This is in line with the 37 provisions what I have discussed originally. And then if at all there is any refund that is due to a tax deductor, that means tax deductor has deducted tax on his own. That means he has taken up the obligation of bearing the tax under 195A. He is making payment to a non-resident, and non-resident says, I have to receive net $10,000. And there is no way that payer can deduct any tax, and that then payer himself will bear the tax, that is grossing up of tax. So in that scenario, suppose by any chance, as per the provisions of DTA or other provisions, if the same transaction is not taxable in the hands of non-resident, then having paid or deducted, having paid that tax under 195A grossing up process, the same tax deductor or the payer can apply for refund. There is a system that has been brought in under section 239A. Earlier, this was not there. One has to go to CIT appeals, filing an appeal stating that I have paid a tax, you have to refund. No, that has been dispensed, and now you can go before the assessing officer and ask him to refund the amount because it has been deducted out of abundant caution, and as per the law, the transaction is not taxable in the hands of NRI. And dispute resolution committee, there is no problem. That is nothing. Now the TPO orders are under revisional jurisdiction. The Commission of Income Tax, International Tax, and TP can revise the orders of TPO. There is some litigation on this. Now it is put at rest. And penalties of 271 AAB, 271 AAC, and AAD, even Commissioner of Appeals can initiate. And even regarding this 285B is extended of reporting requirements under Form 52A. Persons engaged in specified activities. What are the specified activities that could cover even event management and other things which are covered by the specific management of the specific activities? One needs to not only persons who are making the films, but a lot of other activities are added into the ambit, which needs to be taken care of. Friends, I'm very thankful for a very patient hearing of so many clauses, though we thought the number of amendments are limited. Unless you look at the finance bill, you do not know as many as 84 clauses, if I am not wrong, or 84 amendments have been proposed by this finance bill 2022, and 84, that's right. So please go ahead, Pankaj, for want of time, you can get into the.
Yeah, thank you, Prasad.
I will remove the share screen.
Yeah.
1 minute.
And thank you very much for the excellent presentation, Prasad. Of course, what happens is every year we have around 100 amendments made, but at least we have 10 or 15 where we can smile and we can talk something good which will make the mood cheerful. But unfortunately, what has happened is we don't see many such things where we can talk and make people happy. But anyhow, let us just make people happy answering the questions. There were many questions. Some wanted your opinions on what is it. So I'm just trying to avoid them. And I'm straight away coming with questions. And because it's a Basant Panchami day and very auspicious day, and we do the start with the puja of Lord Ganpati. I'll take Ganesh Balakrishnan first question, and then he just says many companies organizes sales conferences for distributors and retailers, and such payments are incurred in form of overseas travel. Why specifically such expenditure for pharma companies is disallowed on doctor-related promotion expenses?
I have my own view that Ganesh is my good friend. So nice having him in the audience. And in a very pertinent question, what he has posed. See, the discussion in the finance bill, especially the memorandum explaining the provisions, exhaustively covered the pharma companies giving freebies to medical practitioners. I don't think the distributors conference or these marketing staff conferences should come in this ambit. That is what I really feel, because that is a very legitimate marketing expenditure. I think even if you give some free travel coupons to your distributors who have really marketed your products, I don't think these restrictive provisions or proposals what have been brought in are going to dampen that. That is what I feel. And anyhow, there is one perquisite what they are telling, that perquisite if it is more than 20,000. So unless that is a perquisite which is to the person and it doesn't fit into the marketing and sales expenditure, of course it's very difficult to decipher what is personal in nature and what can also be treated as marketing promotion expenditure. But if I don't think the distributors and who get this may be visited with these provisions. That is what is my sincere feeling. And definitely what is against the public policy, that is what they have explained in detail, because in the medical practitioner's case, that is categorically prohibited under the code of conduct prescribed by the medical practitioners. Even they took that as a public policy. Any payments made against that would be against the public policy, thereby the allowance is disallowed. I don't think the genuine marketing expenditure on distributors would come under this ambit. That is what I sincerely feel. Anyhow, there is a lot of litigation work which we are going to handle.
Thank you. Jitendra asked, please advise where cess will be required to be added for book profit computation.
Cess is like tax. What you are doing with the tax, the same thing will happen. Cess is now to be treated as an additional surcharge as per case Srinivasan's case of the Supreme Court. That is what is explained in the memorandum also. This time the memorandum itself is 100 pages. Explaining the provisions itself is 100 pages. Very, very surprising. It takes 3 full days for us to read the memorandum in detail. So this cess is no more a cess as per their own circular, which cess they have referred to the state government cess. Now the cess is to be understood as an additional surcharge and sits in the ambit of the taxes. Whatever treatment you give to the taxes under the 115 JB, the same treatment is still has to be given.
Venkatesh JV asks, if an investment is made by an entity from its surplus and earns some exempt income, the amended section 14A cannot disallow any expenditure under Rule 8D. Please confirm.
No, can you repeat that question, Pankaj?
Yeah. If an investment is made by an entity from its surplus and earns some exempt income, the amended section 14A cannot disallow any expenditure under Rule 8D.
No, once you are earning an exempt income, this rule clicks in. See, how can we avoid that? See, there is no exception that you are making surplus funds as investment or the regular funds as investment. No, I don't think that differentiation you can make under the law. See, they have gone far beyond the reality. See, what you are asking is very, very basic. And in the sense, if it is a surplus fund, I must get an exemption, you will never get it. So whether it is surplus fund or the regular fund, once you are earning exempt income, section 14A will definitely click in. There is no way you can avoid it.
Sarangsha asks, in amendment to section 43B, can one argue that the liability to pay interest is not deferred to a future date as the payment is fulfilled by issue of debentures, other instrument, and that the redemption of such debenture or other instrument at a future date is not in the nature of interest?
Yeah, very good question, Sarang. Sarang is my good friend. Very good question. See, what you mean to say, as per the financial institutions or banking perspective, you have met the obligation and you have cleared the interest when once it got converted into a debenture or an instrument. The same concept was there even for conversion of interest into loan in the past also. Conceptually, there is no change. But what they have observed, the government observed that conversion of unpaid interest into loan anyhow was brought into the exclusions, in the sense such conversion would not be deemed as payment of interest. The same philosophy would now apply even for conversion of such unpaid interest into a debenture or any instrument. That is what. So the same philosophy has been explained. So even in the past, with respect to conversion of unpaid interest into loan, from the banking perspective or the financial institution angle, it is deemed to have been paid, which payment, that is a constructive payment, which is not accepted under the income tax law as a payment under 43B. The same philosophy would now apply even for conversion of unpaid interest into debenture or any instrument.
Thank you. Srinivas Murthy K asks, would charging of nominal fee in the case of a trust with the objective of health amount to carrying on commercial activities?
Charging of a fees, we have a limitation. I am not an expert in trusts and institutions. Let me make it very clear. With my limited knowledge on trusts and institutions, the charging of a fee has come up for discussion. I think if it is not wrong, by a Supreme Court judgment in Port Trust case, there is a Gujarat Port Trust case, it has come up. And then they have made a particular ratio, that means this much of receipts. That's what we have mentioned in 1023C also, 20% for commercial receipts, something like that. So if it is going beyond that, it becomes a violation. That is what has been explained. So this has been widely debated. That time, some 8 years back, in that Gujarat Port Trust case, I forgot the exact name of it is not exact, that's a port trust in Gujarat. This is discussed, and to neutralize that judgment, they have brought in an amendment to the provisions of trust and institutions. Till such a ratio is, till such level which is permitted is reached, that is not a violation. If it is going beyond that, definitely it's a violation.
Another question is on section 68 applicability. Here says, but the creditor issue is only in the nature of loan borrowed. So I think this is a remarkable change. Frauds these days are only through such arrangement.
And what these days?
Frauds these days are only through such arrangement.
No, that is the reason the law is getting tightened more and more. That is creating real hardship to the genuine taxpayers. See, what is happening, what is genuinely availed as a facility with respect to the onus of proof by genuine taxpayers is being impacted because of the fraudulent transactions happening. That is always the approach. No, if there is a fraudulent transaction, 1 out of 100, 99 are going to suffer. See, always the concept of Section 68, on which I wrote a book in question and answer format in 2005, published by All India Federation of Tax Practitioners, which book was forward and the vetting was done by P.N. Shah, the past president of ICAI. There is that's All India Federation has brought it in 2005. So always the onus of proof is on the taxpayer, there is no doubt, under Section 68. But once he discharges the onus shifts to the revenue. So when you are able to identify the creditor, and when you are able to establish the genuineness of the transaction, when you are able to prove the basic creditworthiness of the creditor, you have discharged your onus. That is what Shankar Industries case 114 ITR, Calcutta High Court. Shankar Industries case has been phenomenal, and that has been the benchmark all through till now. So this onus is being discharged by the taxpayers religiously. Now what is revenue asking? See, you are a closely held company, not a widely held company. The share application money, what you are receiving, you are putting so many names, the Chinese names, Russians names, so many names you are putting. Thereby it is creating a doubt whether these applicants are really in existence. And I'm just joking in the Chinese name, Russian, and that means XYZ, so many names you are giving, whether they are really existing or not. The concept that was originally given by the Delhi High Court in Stellar Investment, all that has been given a go by. There, what was the concept? If you are able to identify, that is good enough. Now, what is that? Now the companies, they are trying to say, I will identify 4 people. That is good enough. Once the identification is done, you should not ask me beyond that. That is where they have brought in a proviso almost some 7-8 years back or 10 years back, stating that you will have to prove the source of source. Source of source is not to be established. That is what the Honorable Supreme Court said, not required to be established. But unfortunately, through an amendment, what is happening, the taxpayer is obligated to establish source of source. The same approach now is extended even to the loan and borrowing also. If you are covering loan and borrowing, the entire gamut of 68 is covered. What more is left, I don't understand. In real and practical terms. Yes.
Thank you. Kamal Rati asks whether reassessed, recomputed will include 143(2) notice. I think this is for updated return.
Reassess and recomputed.
Will it include 143(2) notice?
143 notice, is it being asked for the purpose of updated return is asking?
That's what I feel like. Kamal bhai can just put it in a question again if you are there. And meanwhile, I'll just take another question from Upendra Gorantla. He asks if dividend received by an Indian company from a foreign entity, wholly owned subsidiary, during 22-23 accounting year will also be at concessional rate of 15%.
No, because that is 23-24 assessment year means the accounting
year 22. Yes.
See, the new law is applicable from 23-24. That means 22-23 financial year transactions are covered. Whatever you receive, that is 115 BBD. 115 BBD. Yes, 1st April 2023. That means 22, 23 you receive. And you have to receive that dividend before 31st March 22. If you are receiving it before 31st March 22, then it will be taxed at 15%. If it is beyond 1st April, on or from 1st April, it would be taxed. And in fact, my good friend Giridhar Mamidi is greeting me. Giridhar is my good friend. Thank you very much, Giridhar, for your kind wishes. I reciprocate. Thank you, Mr. Giridhar Mamidi.
Thank you. Kamal Rati has come back stating that it is for updated return only. So I'm just repeating the question, whether reassessed, comma, recomputed will include 143(2) notice for updated.
No, because if you go for the updation, what are the embargo? I will tell you, Kamal, actually this the embargo is only with reference to search has been conducted or survey has been conducted or books have been requisitioned under 132A or survey has been conducted, notice has been issued to that effect. Okay. So nowhere this 143(2)A notice. What is 143(2)A notice? Let me just go through 143 because Kamal is an expert in this field.
Teacher, examiner, expert.
I know. He's
All in one.
doing a lot of service to the institute. 143(2)A. Meanwhile, you can take another question. I will just come back on this.
Another question is, there are practices where companies make subsidiary distribute dividend, even parent may not have adequate profits.
Okay.
I think the practice of certain companies have brought this amendment for taxing. I think this for that 15% Ganesh Balkrishnan question.
No, Ganesh, actually, this is in the context of a foreign subsidiary, as you rightly say. Practically, it may happen in the startup cases, Ganesh. Because as you know, the startups for the initial 5, 6, 7 years, they will be incurring losses at the apex level. They might come up with some profits in the subsidiaries set up in the other jurisdictions in a limited activity. They might give dividends also, which will help the cash flow of the startups here. So it is a genuine happening. There is no, tax planning or anything here. The original intention of the incentive is well justified in the case of startups, which is now being deprived. And of course, in your cases, in those cases which you are referring, probably there may be some cases where at the head office, the parent level, they are not passing it on. If they are not passing it on, even the ATM benefit would not come, no? Even the ATM benefit would not come. They will have to suffer tax, even at least that 15% tax they have to suffer. So, but in the startup scenario, I think this would be a great disincentive. Yes.
Murli sir is asking, how can income be generated in cryptocurrency? Can you explain with a small example?
Because I have not dealt with cryptocurrency till now. It's very difficult for me to practically explain, but what I understand, you pick up one investment, say at the rate of say 10,000 rupees, and that has become now a lakh of rupees. You are selling it. There is always a representation that I am trading in this activity in a regular manner, so it should be treated as a business activity, so that I can claim so much of expenditure against that and all that. That is one argument which was doing rounds as a representation in the past. And the other one is it would automatically become capital gains. It is an asset. There is no way you can avoid it. Assume for a while there is no 115 BBH now. Even then it would have been taxed under the present law as a capital gains in the normal rates. So whatever you are earning, this 1 lakh minus 10, now 90,000 is to be taxed as per 115 BBH at 30%, probably with surcharge and cess also. it will almost go up to 1/3. If you are a high income earning individual, high net worth individual, the surcharge can create a havoc also. The surcharge can go in a big way, up to 37%. So here it is a capital gains. Now it has been categorically, you can't claim it as a trading eye, even though you are into regular number of frequent number of transactions also, you can't say it is business income. That is one first clarification that has come. And second is, it's a simple calculation, 1 lakh minus 10,000, 90,000, put to tax at 30,000 plus surcharge. That's all.
Sir, I'm taking a question from Rupin Merchant.
What is
Who
that?
asked Rupin Merchant. Partnership firms, profit is exempt, but interest earned at 9% from partnership firm, and the partner has paid interest at the rate of 12% for unsecured loan, but can claim up to 9% interest against partnership firm's interest income. I'm also not very clear about the question. Maybe here they are earning 9% interest from partnership firm, and the investment he has done by borrowing at 12% per annum. So can this interest be set off? Could be the question.
Yes, definitely. There should not be any issue on that, because the income, the profit share is an exempt. That is what is worry, because the profit what is received from the partnership firm is non-taxable. Whether the interest income what he is receiving against the capital can be set off against the interest what he is paying. Okay. Can you link it up? Okay. That's a good question. I don't think you can link them up, and it would be very difficult, I think. I think that cannot be linked up like your bank deposit interest against the loans and all that. Even in the bank deposit interest also, I'm not very sure whether you can do that. Suppose you have a FD against which you are receiving the interest. The same FD you have put it as a mortgage and taken a loan. That loan is again a personal loan for your personal purposes. Can you say that bank interest cannot be brought to tax? I don't think it is possible. I don't think that is possible. Forget about 14A has no application here, but he is asking in a different perspective. I don't think that you can adjust both of them. Yes.
Yes, N. Shankaram, what is the treatment of interest expenditure incurred on borrowed funds utilized for investments under 14A, since the income earned from such investments are now taxable?
Now taxable. Huh?
Yeah.
If those that's what is a very interesting question. Like dividends which were not taxed earlier, now they are taxed. Dividend income for an exempt income earlier, now it is a taxable income. If you are a taxable income, you have every case to argue that 14A would not apply to you for the current year when the dividends are taxed. Where is the question of application of 14A? If at all your investment is confined only to such investment in shares which are earning dividend now. If you have other investments also which still are yielding, then you have a basket of investments, then it becomes a challenge for you to pull out what is taxable and what is not taxable.
I'm taking one question and then lastly leave another for one interesting statement. One is from Dalpati Rao Srinivas Raju. In budget, anything for PSUs, particularly loss-making PSUs?
No, PSUs budgets is a broad question which he is posing. I mean, the disinvestment is happening for PSU loss making only. The Air India is the biggest example with the huge losses and all that. It is disinvested. And definitely the government, I think if I remember right, the Honorable Finance Minister also mentioned in the budget speech that so many PSUs disinvestment is underway. I think she has mentioned the number also to the tune of 11 or 12 PSUs, which are underway for disinvestment.
Narayan Sriman is coming with an interesting statement with respect to virtual digital asset.
Yes.
See, there are case laws as per which if an item is brought to tax from a particular date, it means that earlier the same was not taxable.
That's what is clarified by the CBDT chairman. Now they are classifying this as asset in a very special status. It doesn't mean that the asset was not there in the past. So that has been clarified, stating that the existing tax rules will apply. It is not that what all you have earned up to 31st March 2022 will go tax free. No, that stand we can't take.
Sir, thank you. It's 40 minutes. We have crossed the question.
No, let me just complete Kamal
Bhai's question.
143.2a. That is, I'm not able to figure out what it is. 143.2a. I'm sorry, 142.2a. That's what he has mentioned.
43.
142. 142.2a. Correct. 142.2a. Is any stage of proceedings assessing officer having regard to the complexity in opinion on the so and so. See, if it is 142.2a, I'm of the view that it is not getting covered, and that
It's
it's
143.2 notice only is talking about.
No, 2a, if I remember right, 142.2a is where they can inquiry before assessment. 143.2, there is no 2a in 143.2.
Only two only. Whether reassessed, recomputed will include 143.2 notice.
There is no a, no? There is no a, he has mentioned.
No a.
Okay. Then if it is 143.2, absolutely no problem. But what happens is, if you are already received a notice and the assessment is happening, you are deprived. No, you cannot file updated return for that year. That is clearly there in the law. If not only reassessment, even assessment notice, if you receive and the assessment proceedings are underway, you can't file an updated return for that year.
Thank you, Prasad. Just wanted to inform you that there's a committee meeting also going on.
Oh, excellent.
So, and because I cannot go there, I've been given this task by chairman. So one is kindly, thank you very, very much for, as usual, excellent presentation on part 1. You have completed. Now there's another part of international taxation also, which I know it will come in October, where I can join as an attendee. But as of now, thank you very much. Kindly accept this small token thank you note on behalf of Hyderabad branch of ICAI.
Thank you very much. It's my pleasure always. This is a great opportunity of learning for me. And I always treat it as a sacred duty for my own Hyderabad branch of the Institute. Thank you very much.
Thank you very, very much. You have been a great source for us. And I know that you are there for us. So only thing is some arrogance has crept up amongst many of us who are not listening to budget, not listening to any other meeting, because they are saying Prasad bolta na jab sun lege. Okay, which I don't know. So anyhow, we should not be doing like that. And friends, thank you very, very much for being with us. I'm sorry I missed some questions because it's already 1:40 and we can't delay the speaker for so long. But again, sir, as usual, excellent job. Thank you very much. So let us sign off.
Thank you very much. All the best. All the best. I'm leaving, Mr. Pankaj. Thank you.